Come into my trading room, a complete guide to trading by Dr. Alexander Elder, full audiobook summary. Have you ever found yourself paralyzed by a market dip or felt the thrill of a winning trade turn to fear as you watched your profits disappear? What if the biggest barrier to your success isn't the market, but the psychology behind your decisions? Welcome to Power Books, your go-to channel for powerful book summaries on self-development, success, business, motivation, trading, investing, and psychology. We're here to break down the most impactful books on wealth building, mindset, and personal growth, so you can absorb life-changing lessons in minutes. Whether you're aiming for financial freedom, mastering the law of attraction, or developing a disciplined trader's mindset, Power Books delivers the knowledge you need to succeed. Today, we're diving into a book that's an essential guide for anyone serious about succeeding in the market. Come into my trading room, a complete guide to trading by Dr. Alexander Elder. This isn't just another book filled with stock charts and complex indicators. Dr. Elder, a professional psychiatrist, brings a completely different perspective to the market. He reveals that successful trading isn't a get-rich-quick scheme. It's a holistic system built on three foundational pillars: mind, method, and money management. In this deep dive, we'll expose the psychological traps that sabotage even the most talented traders, decode the systematic approach to finding and executing high-probability trades, and most importantly, show you how to protect your capital at all costs. So, if you're ready to stop gambling and start trading like a professional, grab your notebook because our journey into Alexander Elder's trading room starts now. Part 1. Financial Trading for Babes in the Woods. Chapter 1. Invest, Trade, Gamble. The first chapter of Come Into My Trading Room lays out a fundamental distinction that is crucial for anyone entering the financial markets. Dr. Elder argues that there are three types of participants: investors, traders, and gamblers. The key to success is to recognize which group you belong to, and most importantly, to avoid the traits of a gambler. The investor, the farmer. An investor's mindset is all about patience and long-term growth. Dr. Elder compares them to a farmer who plants a seed and nurtures it over a long period. They are not concerned with daily or weekly price fluctuations. Instead, they focus on the long-term health and potential of an asset. Mindset, a long-term horizon, often holding positions for years or even decades. Method, relies on fundamental analysis, studying a company's financial statements, business model, management team, and overall market position. Goal, to build wealth steadily over time through capital appreciation and dividends. The gambler, the thrill seeker. In the world of finance, the gambler is the most dangerous personality type. They are driven by emotion and a desire for quick, easy money. This approach is not a professional one. It is an addiction to the thrill of a big win. Mindset, impulsive, lacks a plan, and is driven by greed and fear. They chase hot tips and rely on pure luck. Method, has no system for entering or exiting trades. They often risk more than they can afford to lose. Psychology, the gambler is addicted to the action and the emotional roller coaster of winning and losing. The market is a negative-sum game for the gambler, who is destined to lose in the long run. The trader, the professional. A trader, in Dr. Elder's view, is the only one of the three who approaches the market as a professional business. A trader is a disciplined individual who recognizes that success is a matter of skill, not luck. This is the path the book guides you on. The foundation of a successful trader's approach rests on what Dr. Elder calls the 3 M's. 1. Mind, psychology. This is the most crucial M. A trader must have a disciplined mind, free from the emotions of greed and fear that plague the gambler. They must be self-aware and follow a system, regardless of their feelings. 2. Method, technical analysis. A trader must have a systematic approach to identifying opportunities. This is often based on technical analysis, using charts and indicators to determine entry and exit points. A method is a set of rules that dictates when to buy, when to sell, and when to cut losses. 3. Money management, risk control. This is the ultimate key to survival. A trader never risks more than a small, predefined percentage of their total capital on any single trade. This protects them from blowouts and ensures they can continue to trade even after a series of losses. Chapter 2: What Markets to Trade. This chapter serves as a crucial guide for new traders, helping them navigate the vast world of financial markets. It breaks down the key characteristics of different markets, making it easier to decide which one aligns with your financial goals and risk tolerance. It's designed to help you understand the pros and cons of trading in stocks, futures, and options. A quick guide to financial markets. This is a great starting point for understanding your options as a new trader. Stocks, or equities represent ownership in a company. They are the most familiar market for most people. Pros: you can choose from a huge variety of companies, from established giants to new startups. There's plenty of information available, and the stock market is generally considered to be more stable than other markets. Cons: stocks can be volatile, especially individual ones. You have to pay commissions, and you're limited to trading when the market is open. Futures. Futures are contracts that obligate you to buy or sell a specific commodity or financial instrument at a predetermined price on a future date. Pros: you get a lot of leverage, which means you can control a large position with a small amount of capital. They're very liquid, and you can trade them almost 24 hours a day, which is a big advantage over stocks. Cons: the high leverage is also a risk. A small price move against you can result in a big loss. They're also very volatile, which requires a strong understanding of risk management. Options. Options give you the right, but not the obligation, to buy or sell an asset at a set price by a certain date. Pros: they offer a high degree of leverage, and your risk is limited to the premium you pay for the option. This is a key difference from futures. Cons: options are complex and can expire worthless, meaning you lose your entire investment. They're not suitable for beginners and require a lot of study. Chapter 3: Technical Analysis. After deciding what markets you'll trade, the next step is to learn how to analyze them. Dr. Elder argues that technical analysis is the essential tool for any trader. He describes it as the language of the markets, where prices, volume, and open interest tell a story about what is happening. By studying these charts, you can understand market psychology and make more informed decisions. Understanding price charts. The foundation of technical analysis is the price chart. It is a historical record of a market's movements over time. The most important types of charts for traders are bar charts and candlestick charts. A candlestick chart, for example, is a powerful visual tool that shows 4 key pieces of information for a given period: a day, an hour, etc. The opening price, the closing price, the high, and the low. The body of the candlestick shows the range between the open and close, while the wicks or shadows show the high and low prices. This visual representation allows traders to quickly understand who was in control during that period, the buyers or the sellers. The importance of trends. The single most important concept in technical analysis is the trend. A trend is the general direction in which a market is moving. Elder explains that there are 3 types of trends. Uptrends, characterized by a series of higher highs and higher lows. This indicates that buyers are in control. Downtrends, characterized by a series of lower highs and lower lows. This indicates that sellers are in control. Sideways trends, the market is consolidating without a clear direction. The core principle here is to trade with the trend, not against it. Support and resistance. Another key concept is support and resistance. Support is a price level where a downtrend is expected to pause due to a concentration of demand. Think of it as a floor that the price has difficulty falling through. Resistance is a price level where an uptrend is expected to pause due to a concentration of supply. This acts as a ceiling that the price struggles to break above. These levels are not fixed lines, but are zones where the forces of supply and demand are in balance. Part 2: Trading for a Living. Chapter 4: Mass Psychology. In this chapter, Dr. Alexander Elder delves into the powerful concept of mass psychology, explaining how the collective behavior of market participants drives price movements. He argues that markets are not just rational mechanisms, but are deeply influenced by the emotional states of the crowd. The market crowd as a single entity. Elder introduces the idea of the market as a single, living organism or crowd. Just like a mob or a group of people, this crowd has its own emotions, beliefs, and behaviors. It is not the individual actions of millions of people, but the collective panic and greed that cause sharp market movements. Individual traders often feel the strong pull to conform to the crowd's sentiment, which is why it can be so difficult to stand apart from the general trend. The dynamics of fear and greed. According to Elder, the two primary emotions that govern the trading crowd are greed and fear. Greed drives prices up as traders rush to buy, fearing they will miss out on a rally. This happens when the crowd becomes overly confident and believes that a trend will continue indefinitely. Greed creates market tops as prices become unsustainable. Fear takes over when the market turns, causing a rush to sell. Traders panic and sell their positions at any price, fearing they will lose all their gains or more. Fear creates market bottoms and rapid sell-offs. These emotional extremes create the familiar boom and bust cycles that we see in all financial markets. The perfect emotional state for the crowd is a state of panic, as it leads to the largest price movements. The trader's place in the crowd. A key lesson from this chapter is that a successful trader must learn to think independently. You should not follow the crowd, but instead analyze its behavior from the outside. Elder compares this to being a secret agent or a spy observing the crowd's actions without being caught up in its emotions. He emphasizes that a smart trader doesn't try to predict what will happen next, but instead reacts to what the market is doing. By understanding the crowd's emotional state, a trader can anticipate potential turning points and avoid getting trapped in the collective panic or greed. Market tops and bottoms. Elder explains that tops are a process, while bottoms are an event. A market top forms slowly as the market's enthusiasm wanes and traders begin to have second thoughts. The price might fluctuate in a range before finally breaking down. A market bottom is often a sharp, panicky sell-off, where the market capitulates in a single day or a few days of frenzied selling. Once everyone who wants to sell has sold, the selling pressure is exhausted and the market can begin to turn around. This is often an opportunity for a contrarian trader to buy when the crowd is most fearful. Key takeaway. The main takeaway from this chapter is that the market is a reflection of human nature. By understanding the psychological drivers of the crowd, greed, fear, and panic, a trader can develop the discipline to act independently. This awareness is the first step toward managing your own psychology, which is the focus of the next chapter. Chapter 5, Individual Psychology. Chapter 5, Individual Psychology. In this chapter, Dr. Alexander Elder shifts the focus from the collective market to the individual trader's mind. He argues that while understanding mass psychology is important, mastering your own emotions and biases is the single most critical factor for long-term trading success. Elder emphasizes that trading is a ruthless sport, where the biggest competition is not with other traders, but with yourself. The problem of inconsistency. Elder identifies inconsistency as a primary symptom of poor individual psychology. Many traders experience a yo-yo effect with a series of successful trades followed by a complete wipeout. This happens because they are not acting according to a disciplined plan. Instead, they are being driven by emotional states such as overconfidence and fear. A trader might make rational decisions when they are calm, but then panic when faced with a loss, leading to impulsive and destructive actions. The 3 M's of trading success. The chapter reinforces the 3 M's introduced earlier in the book. 1 Mind, the psychology of trading, which Elder considers the most important. 2 Method, the trading system or approach you use. 3 Money, the risk and money management rules you apply. Elder stresses that a brilliant method and perfect money management rules are useless without a calm and disciplined mind. Your mind must be in control to execute the other 2 M's consistently. The trader's diary as a tool. The most practical tool Elder recommends for self-mastery is the trader's diary. He insists that every trader should keep a journal of their trades, but not just a record of entry and exit prices. The diary should also include notes on your mental state before entering the trade, Your emotional reactions during the trade, e.g., excitement, anxiety, fear. Your discipline in following your trading plan. Lessons learned from both wins and losses. By reviewing this diary, a trader can identify recurring psychological weaknesses. For example, they might notice they are prone to revenge trading after a loss, or that overconfidence leads them to take excessive risks after a large win. This self-awareness is the first step toward correcting these destructive behaviors. The dangers of greed and fear. Elder revisits the core emotions of greed and fear, but this time from an individual perspective. Greed. It makes you hold a winning trade for too long, refusing to take profits in the hope of an even bigger gain. Fear. It makes you exit a profitable trade too early or refuse to enter a trade at all due to anxiety. Mastery of individual psychology means acknowledging these emotions, but not letting them dictate your trading decisions. Your trading plan must be the boss, not your feelings. Key takeaway. The key takeaway is that trading success begins with self-knowledge. By using a disciplined process, such as keeping a detailed trading diary, you can identify and correct your own psychological flaws. Elder's message is clear. A trader cannot truly compete with the market until they have learned to compete with themselves. Chapter 6. Managing your trading. In this chapter, Dr. Alexander Elder takes a significant step away from theory and into the practical, day-to-day work of a trader. This chapter is all about creating a professional framework for your trading activities. It's the method component of the 3 M's and provides concrete steps to ensure you're making decisions with logic, not emotion. The trading system. Elder emphasizes that every successful trader must have a trading system, which is a set of objective rules for making decisions. This system should answer 3 critical questions for every trade. 1. When to enter. 2. When to exit a losing position. Protective stop. 3. When to exit a winning position. Profit target. A good trading system should be tested on historical data to prove its effectiveness. Having a plan that you've already backtested and proven gives you the confidence to execute trades without letting fear or greed take over. The triple screen system. A key concept introduced in this chapter is the triple screen system, a method for analyzing the market across multiple timeframes to make better trading decisions. This system aims to prevent a common mistake, trading against the major trend. Screen 1. The trend weekly chart. Use a long-term chart, example weekly, to identify the major trend. This determines your trading bias. You should only buy in an uptrend and only sell in a downtrend. Screen 2. The wave. On a shorter time frame, example daily, identify counter-trend moves. These are the waves within the larger tide. You want to find an entry point at the end of a counter-trend move, right as the price is about to resume the main trend. Screen 3. The entry intraday chart. Use an even shorter time frame, example intraday, to find the precise entry point for your trade. You are looking for a signal that the counter-trend wave is over and the main trend is resuming. By using this approach, you're aligning your trades with the most powerful force in the market, the major trend, and using short-term moves for timing. The importance of stops. Elder makes a strong case for the importance of protective stops. He states that the mark of a professional trader is their ability to control their losses. A protective stop is a predetermined price level at which you will exit a trade if it moves against you. This is an objective, mechanical way to manage risk and protect your capital. He also discusses trailing stops, which allow you to lock in profits as a winning trade moves in your favor. Key takeaway. Chapter 6 shifts the focus to the practicalities of trading. The main takeaway is that a trading system is a non-negotiable component of success. It removes emotion from the decision-making process, replacing it with a logical, repeatable set of rules. The triple screen system is Elder's powerful example of how to develop such a method by using multiple timeframes to stay on the right side of the market's major trend. Chapter 7. Managing your money. In Chapter 7, Managing Your Money, Dr. Alexander Elder declares that money management is the single most important component of successful trading. While a sound trading system, method, and a disciplined mind are essential, they are useless without a strict set of rules to protect your capital. Elder's core message is that the primary goal of any trader is not to make big profits, but to survive. By strictly limiting your risk, you ensure you can stay in the game long enough for your skills to grow. Rule. Elder's most famous and fundamental rule of money management is the 2% rule. This rule states that you should never risk more than 2% of your total trading capital on any single trade. The risk is defined as the difference between your entry price and your protective stop-loss price. To apply this rule, you first calculate your maximum allowable loss in dollars, 2% of your account. Then you determine the size of your position, the number of shares or contracts, based on the distance to your stop-loss. This ensures that no matter how many trades you have open, the total potential loss from a single trade is always capped at a small, manageable percentage of your account. The 6% rule. The 6% rule is a monthly risk control mechanism designed to prevent a devastating drawdown. It works in conjunction with the 2% rule and is a critical failsafe. The rule is simple. If your total account equity falls by 6% or more at any point during a calendar month, you must stop trading for the remainder of that month. This rule is a psychological tool as much as a mathematical one. It forces you to take a break after a period of poor performance, giving you time to step back, analyze what went wrong, and prevent the emotional spiral of revenge trading or doubling down that can quickly wipe out an account. It disciplines you when you are most vulnerable. Key takeaway. The key takeaway from this chapter is that a trader's job is not to find a perfect method, but to survive long enough to capitalize on their skills. The 2% and 6% rules are not optional guidelines. They are the bedrock of professional trading. By implementing these rules, you take the decision to risk a certain amount of money out of the heat of the moment and make it a cold, rational calculation, allowing you to focus on executing your trading system with discipline. Part 3. The Organized Trader. Chapter 8. Managing Your Time. In Chapter 8, Managing Your Time, Dr. Alexander Elder emphasizes the importance of a structured, disciplined daily routine for traders. He argues that a lack of organization is a primary reason many traders fail. This chapter provides a clear blueprint for how to manage your time and your trading activities to maximize efficiency and minimize emotional interference. The trader's workspace and routine. Elder stresses that trading should be treated as a serious business, not a hobby. This starts with creating a professional workspace. He suggests that a trader's desk should be neat, with all necessary tools easily accessible, much like a surgeon's operating room. The physical organization of your space reflects your mental discipline. The chapter then outlines a systematic daily routine. Morning preparation. Before the market opens, a trader should review the news and major economic reports to understand the overall market climate. This is not about reacting to every headline, but about understanding the broad, underlying trends. Pre-market analysis. This is the time to identify potential trading opportunities based on your strategy. You should be scanning for setups that fit your criteria, not impulsively jumping into trades. This includes setting entry, stop loss, and profit target levels before you place any orders. During trading hours, once the market is open, your job is to execute your pre-planned trades. Elder warns against the temptation of overtrading or acting on impulse. Your focus should be on following your system and avoiding emotional decisions. The most critical part of the routine is the post-market review. You should carefully analyze every trade you made that day, both winners and losers. The Trading Journal. The centerpiece of Elder's approach to time management is the Trading Journal. He insists that every trader must keep a detailed written record of their trades. A journal is not just a list of entries and exits, it's a tool for self-analysis and learning. For each trade, you should record the setup and your reason for entering the trade, the entry and exit prices, the size of the position, your emotional state during the trade, a post-trade analysis of what went right and what went wrong. The journal helps you identify your strengths, recognize your recurring mistakes, and track your progress over time. It transforms you from a gambler into a student of the market. Key takeaway. Chapter 8 teaches that success in trading is about discipline and routine. By treating trading as a professional endeavor and meticulously managing your time and records, you create a feedback loop for continuous improvement. The trading journal is your most powerful tool in this process, helping you to objectively analyze your performance and turn every trade into a learning opportunity. Chapter 9, the daily and weekly routines. In Chapter 9, Dr. Alexander Elder turns his focus to the practicalities of a successful trading life by detailing the specific daily and weekly routines that separate professional traders from impulsive amateurs. This chapter is a direct follow-up to Managing Your Time, providing a step-by-step checklist to ensure you are consistently disciplined and organized. The daily routine. Elder argues that a trader's success is built on a solid daily routine that prevents emotional decisions and promotes a methodical approach. Morning preparation, pre-market. Before the market opens, a disciplined trader performs essential analysis. This is the time to check for significant economic news, earnings reports, and other catalysts that might affect your positions or watch list. Most importantly, you should be identifying potential trade setups that fit your system and predefining your entry, stop loss, and profit targets. You must complete your analysis and form your plan before the chaos of the market open begins. During trading hours, your only job during market hours is to execute your pre-planned trades. Elder strongly warns against the temptation to overtrade or make impulsive decisions based on fleeting price movements. If a setup doesn't meet your predefined criteria, you should not take the trade. The market's noise should not distract you from your plan. Post-market review. The most valuable part of the day comes after the market closes. This is your time to review every trade, both winners and losers. You should ask yourself why you entered, how you managed the trade, and what you learned. This is also when you update your trading journal, the most crucial tool for self-improvement. Elder emphasizes that without a thorough review, you will repeat the same mistakes. The weekly routine. While the daily routine focuses on execution, the weekly routine is all about getting the big picture perspective and planning for the long term. Weekend analysis. The weekend is for analyzing longer-term charts, such as weekly and monthly charts, without the daily noise. This helps you identify major trends, support, and resistance levels that are invisible on a daily time frame. Elder advises that this high-level view should guide your trading for the coming week. Portfolio review. Take time to review your overall portfolio's performance. Assess your total risk exposure, evaluate your position sizing, and decide if you need to adjust your strategy based on your recent performance. This is the time to zoom out and manage your overall trading business. The core message of this chapter is that trading is a business, and every business needs a structured plan. By committing to a consistent daily and weekly routine, you eliminate the guesswork and emotional chaos that often lead to failure. Chapter 10, Your Trading Journal, a Practical Guide. A trading journal is your most powerful tool for self-improvement. It's not a dry log of numbers, but a detailed account of your decisions, emotions, and lessons learned. Dr. Elder argues that consistent journaling is what transforms an amateur gambler into a professional trader. This guide will help you create a detailed journal that serves as a constant mirror for your trading mind. Part 1. The core components of a journal entry. Every single trade, whether a winner or a loser, deserves a dedicated entry. Here's a breakdown of what each entry should contain. 1. The pre-trade plan. This section is written before you enter the market. You must commit your plan to writing before the emotions of a live trade can cloud your judgment. The setup. What specific signal or chart pattern led you to consider this trade? For example, price bounced off support and the MACD turned up. Your rationale. Why is this a good trade? What are the key factors in your favor? Entry, stop, and target. Where will you get in? What is your strict stop-loss price? Where is your profit target? This must be decided and written down in advance. Position sizing. What is the exact size of your position based on your risk management rules? 2. The live trade. During the trade, it's important to note your reactions. This helps you identify behavioral patterns. Emotional notes. How do you feel as the price moves? Are you calm, anxious, or greedy? Action log. If you deviate from your plan, e.g., move your stop, take profit early, note it down and explain why you did it. 3. The post-trade analysis. This is the most valuable part of the process, done after the trade is complete. Trade outcome. What was the final result, win or loss? Review your plan. Did you follow your pre-trade plan exactly? Why or why not? Be brutally honest with yourself. Lessons learned. What did you learn from this experience? Was your analysis flawed? Did your emotions cause you to make a mistake? What will you do differently next time? Part 2. The power of psychological recording. Your journal is most powerful when you use it to identify psychological weaknesses. Record every feeling you have, from the excitement of a new trade to the frustration of a loss. By doing this, you'll start to see patterns. For example, you might discover that you consistently get impatient and enter trades too early, or that you are overconfident after a big win and take on too much risk. Your journal becomes a mirror that shows you your own mind. Part 3. The weekly review. Writing in your journal daily is crucial, but reviewing it is where the real learning happens. Every week, set aside time to read through all your entries. Look for recurring patterns. Are your losses coming from the same type of setup? Are you consistently moving your stop loss and turning small losses into big ones? Are you getting overly confident after wins? Identifying these patterns is the first step toward correcting them. Your journal becomes the roadmap for your self-improvement. By following this process, your trading journal will transform from a simple log into an active, strategic tool that continuously hones your skills. Part 4. Trading in Practice. Chapter 11. Trading with the First Brother, the Mass Mind. Chapter 11 teaches that the market is a battlefield where masses of traders struggle with greed and fear. Successful traders don't fight the crowd. They learn to read its mood and move with it. Technical analysis, far from being a mystical art, is the perfect tool for this, because chart patterns are simply a record of the collective human decisions made in the market. Every peak shows the moment greed took over, and every trough shows where fear became dominant. The three-screen trading system. This system is the practical application of trading with the mass mind. It's designed to filter out bad trades by confirming a signal across 3 different time frames or screens. The goal is to ensure you are always trading in the direction of the dominant market trend. 1. The first screen, the long-term trend. Purpose: to identify the primary direction of the market's mass mind. This is the most important filter. What to use: a weekly chart. Dr. Elder recommends using a 13-week exponential moving average, EMA, or a simple trend line. The rule: you only trade in the direction of this trend. If the trend is up, you only look for buying opportunities. If the trend is down, you only look for shorting opportunities. This prevents you from fighting the main market momentum. 2. The second screen, the intermediate wave. Purpose: to find a temporary wave or pullback against the long-term trend, allowing for a low-risk entry. What to use: a daily chart along with an oscillator. A common choice is the MACD, moving average convergence divergence. The rule: wait for the oscillator to move against the main trend on the daily chart. For example, in an uptrend, screen 1 is up, wait for the MACD to dip into negative territory on the daily chart. Screen 2 is down. This signals a temporary retracement, offering a better entry price. 3. The third screen, the entry. Purpose: to time the precise moment of your entry after the first 2 screens have given you a signal. What to use: a very short-term chart, example intraday, or simply a buy-stop order placed 1 tick above the high of the previous day's trading. The rule: enter only when the intermediate wave starts to turn back in the direction of the long-term trend. This can be done by waiting for a bullish reversal on the daily chart or by using a buy-stop order. This ensures you only enter when the momentum has shifted back in your favor. By using this 3-screen system, you are essentially aligning your personal trades with the dominant flow of the market's mass psychology. You're not trying to guess a reversal. You're patiently waiting for the market to signal its next move, and then you're jumping on board. Why it works. The beauty of this system is its inherent discipline. It forces you to be patient and to wait for confirmation. It prevents you from chasing trades or entering on a whim. Instead, you're systematically following the collective behavior of the market, which is reflected in the chart patterns you analyze. The system is your mental guardrail, protecting you from the emotional traps of greed and fear. Chapter 12, Trading with the Second Brother, Your Personal Psychology. Trading with your personal psychology. Dr. Elder identifies the second brother as your own personal psychology. No matter how good your method or how well you read the mass mind, it's your discipline or lack thereof that will ultimately determine your success. The market doesn't care about your opinions or feelings. It will take your money if you let your emotions override your logical plan. The Trading Diary. The most critical tool for managing your trading psychology is a trading diary. This isn't just a record of your trades, it's a journal of your emotional state. Dr. Elder emphasizes that you must write down why you entered each trade, what your emotional state was at the time, and what you learned from the outcome. What to record. The entry and exit price, stop loss, and profit target. The market conditions and what your technical indicators were telling you. Your emotional state. Were you feeling greedy, anxious, overconfident? What you learned from the trade, both the good and the bad. By keeping a detailed diary, you can identify patterns of self-sabotage. You might discover you consistently break your rules on Fridays, or that you tend to overtrade after a big win. The diary turns your emotional impulses into data you can analyze and correct. Understanding the internal enemy. Dr. Elder discusses several psychological traps that traders fall into. Greed, the impulse to hold a winning trade for too long, turning a profit into a loss. Greed also drives overtrading, where you seek out new trades just for the sake of action. Fear, the urge to cut a winning trade short or to miss a good entry because you're afraid of losing. Fear can paralyze you, causing you to hesitate and miss opportunities. Revenge trading. After a loss, you might feel a powerful urge to get back at the market by entering a risky, impulsive trade to quickly recover your losses. This is a common path to even bigger losses. Rationalization, the tendency to invent reasons to justify a bad trade or to break your own rules. This is your mind's way of avoiding accountability. The importance of self-discipline. The core message of this chapter is that a trader's success is a direct reflection of their self-discipline. Your method is only as good as your ability to stick to it. Dr. Elder's solution isn't to fight your emotions, but to build a framework that makes impulsive behavior impossible. This framework includes 1. Strict risk management. Only risk a small percentage of your total trading capital on any single trade. This keeps losses small and prevents any single trade from becoming an emotional event. 2. Trade planning. Every trade must have a clear plan for entry, exit, and a stop-loss order before you place the trade. Once the plan is made, your job is simply to execute it without emotion. 3. Meditation and relaxation. Dr. Elder suggests simple meditation or relaxation exercises to calm your mind before you even look at the charts. A calm mind is a rational mind. Ultimately, Chapter 12 is about accepting that you are your own worst enemy in the market and that you must build a system to outsmart yourself. It's a journey of continuous self-improvement. Chapter 13, Trading with the Third Brother, Your Trading Method. Trading with the Third Brother, Your Trading Method. A trading method is more than just a set of technical indicators. It's the synthesis of the first two brothers, the market's mass mind and your own personal psychology. Your method is your action plan, the set of rules that governs every single decision you make in the market. Without a clear method, you're just gambling. With one, you're executing a well-thought-out strategy. The 3 M's, mind, method, and money. Dr. Elder consolidates the entire book into 3 essential pillars, often called the Holy Trinity of trading. Mastering all 3 is non-negotiable for long-term success. 1. Mind. This is your personal psychology, the subject of Chapter 12. It's your discipline, emotional control, and the ability to stick to your plan even when the market is trying to scare or tempt you. The mind is the foundation. A poor mindset will undermine any method or money management system. 2. Method. This is your specific trading system, the subject of this chapter. It includes all your rules for when to enter a trade, where to place your stop loss, and how to take profits. Your method should be based on a clear analysis of the market's mass psychology, the first brother. A great method is objective, logical, and removes the need for impulsive decision-making. 3. Money. This is your risk management, or how much you're willing to lose on any single trade. It's a key part of your method and a reflection of your discipline. Dr. Elder insists on keeping your risks small, typically no more than 1% or 2% of your total trading capital per trade. This simple rule ensures that no single loss can wipe you out, allowing you to survive long enough to learn and grow as a trader. The written trading plan. The most important takeaway from this chapter is the necessity of a written trading plan. Your method should not be an abstract idea in your head. It must be a physical document that you follow. This plan acts as your final mental guardrail, preventing you from deviating from your rules. Your written plan should be a checklist that includes the criteria for your 3-screen trading system, your maximum risk per trade, your money management rule, your criteria for placing a stop loss and a profit target, specific rules for taking a loss or exiting a winning trade, a section for your trading diary where you can reflect on your decisions. By writing down your plan, you are formalizing your commitment to a disciplined approach. You're no longer just hoping for a good outcome. You're executing a well-defined strategy. Conclusion: a trading method is the final piece of the puzzle. It takes the concepts of mass psychology and personal discipline and turns them into a tangible, repeatable process. It is the core of a trader's profession. All right, everyone. Welcome back to the Trading Tribe. We've just navigated a complete blueprint for success, exploring the psychological, strategic, and financial waters laid out in Come Into My Trading Room. Dr. Elder has shown us that being a successful trader isn't about getting lucky. It's about mastering the 3 essential pillars of the game. First, your mind. This is your ultimate control room, where you master your emotions and stay disciplined. Second, your method. This is your personal blueprint, the precise system you use to enter, manage, and exit trades. And most importantly, money management. This is the simple yet powerful law that ensures you survive to trade another day. This book has shown us that trading isn't about being right. It's about being prepared. It's about the eternal game of turning from a hopeful gambler into a disciplined strategist. It's about seeing the market for what it is and acting with an unwavering plan. For those of you who want to take these skills to the next level, another powerful book is popping up on your screen right now. It's a must-read and a must-listen to take your journey to the next level. Remember, here at PowerBooks, we live by the motto, knowledge is not power. The application of knowledge is power, and applying the wisdom from Dr. Elder's work will undoubtedly empower your journey. If this summary gave you the clarity you've been looking for, make sure to smash that like button, subscribe to PowerBooks, and hit that notification bell so you never miss our next deep dive. Keep learning, keep applying, and keep building the discipline you need to win. Thanks for joining us, and we'll see you next time.